Today is December 22, 2025. We're witnessing silver trading around the $58 per ounce mark, a price level approaching historical highs. However, in today's in-depth report, I invite you to temporarily look past the short-term price fluctuations on your tickers and focus instead on a structural shift that is occurring quietly but decisively beneath the market's surface. Typically, when an asset experiences a sharp rally, our immediate concern is whether the market is overbought. Yet, current analysis of capital flows and physical inventory data tells a completely different story. We are not looking at a short-term speculative bout, but rather the inception of a systemic supply crisis. My core thesis in this report is as follows. The silver market is entering a new phase of price discovery, driven by the convergence of three factors: a prolonged structural supply deficit, irreplaceable industrial demand, and most importantly, a paradigm shift in the strategic reserve policies of Eastern powers. Let us begin with the most critical macroeconomic factor that the mainstream media is largely overlooking: the actions of sovereign actors. 2024 marked a historic turning point when the Russian Ministry of Finance officially allocated a budget of $535 million, approximately 51 billion rubles, for precious metals purchases over the 2025-2027 period. What is notable here is not just the figure, but the asset class. For the first time in over 50 years, silver has been classified as a national strategic reserve asset, alongside gold, platinum, and palladium. Why is this a critical signal? For 170 years, central banks have demonetized silver, relegating it to a purely industrial role. Russia's move represents a reversal of this century-long trend. Analyzed through the lens of geopolitical risk management, this is a calculated move to sanction-proof national assets. Following the freezing of $300 billion in foreign exchange reserves in 2022, nations like Russia and the BRICS Plus bloc have realized a hard truth. Only physical assets located within domestic vaults are truly free of counterparty risk. Alongside Russia, we must address China, the world's factory. Although China possesses the world's third-largest silver reserves, approximately 70,000 tons, import data reveals an unusually voracious appetite. China currently controls over 80% of global solar panel production and is growing its electric vehicle manufacturing at a rate of 40% annually. Both industries view silver as an irreplaceable input material. If we examine China's gold accumulation model from 2015 to the present, there is a strong basis to assert that Beijing is applying a similar strategy to silver: strategic accumulation to secure its industrial and technological dominance for the coming decade. The fact that the world's second and 11th largest economies have simultaneously shifted to a net buyer status for physical silver will create a hard price floor, regardless of short-term currency fluctuations. Now, let us drill down into the specific numbers from the Silver Institute and global mining data. A value investor always looks at the fundamentals, and silver's fundamentals are currently in their most severe state of imbalance in modern history. 1. Structural deficit. We are entering the fifth consecutive year of a silver market deficit. In 2024, total demand reached 1.16 billion ounces, while total supply, including mining and recycling, reached only 1.01 billion ounces. This resulted in a deficit of 148.9 million ounces in a single year. If we calculate the cumulative deficit from 2021 through 2024, the world has consumed a net deficit of 678 million ounces of silver. To put this in perspective, this figure is equivalent to wiping out 10 months of total global mining output. This volume has been drawn from above-ground stockpiles and consumed permanently. It is not returning to the market. 2. Inelastic industrial demand. Unlike gold, which is primarily an investment asset, silver is an essential industrial metal. Industrial demand hit a record 680.5 million ounces in 2024. The primary drivers are the renewable energy and high-tech sectors. 3. Supply inelasticity. This is the Achilles heel of the supply side. Approximately 70% of global silver output does not come from primary silver mines, but is a byproduct of copper, zinc, and lead mining. What does this imply? It means that even if silver hits $100 an ounce, mining companies cannot simply increase silver output if the prices of copper or zinc do not justify expanding operations. Furthermore, supply from primary silver mines is in secular decline, as easily accessible high-grade deposits have been depleted. Permitting and constructing new mines takes 5 to 10 years. We cannot expect any short-term supply surge to alleviate this pressure.
As risk managers, we must pay particular attention to the state of certified inventories. This is the market's liquidity buffer, and this buffer is thinning at an alarming rate. At the COMEX, USA, registered silver, inventory available for immediate physical delivery, has plummeted by over 50% from 152 million ounces in 2021 to approximately 73 million ounces by late 2024. In London, LBMA, inventories are also at record lows. After deducting holdings allocated to ETFs, the actual free float remaining is negligible. The danger lies in the leverage ratio within the paper market, derivatives. Currently, open interest on the COMEX exceeds the actual physical silver involved by multiples. The ratio of paper claims to registered ounces is at extreme levels, estimated around 18 to 1. This creates a risk of a short squeeze, similar to the nickel event on the LME in 2021, but on a much larger scale. When sovereign nations or major industrial entities demand physical delivery instead of cash settlement, the market will face an immediate liquidity shock. The divergence between the spot price and the actual cost to secure physical metal, physical premium, will widen. In such a scenario, the price listed on the exchange may no longer reflect the true value of the metal. So, is the current price of $58 to $61 the top? To answer this, we must place it within the context of comparables and inflation. First, regarding the gold-silver ratio. The ratio currently sits at 72 to 1, with gold at near $4,200. The historical average typically ranges from 40 to 1 to 60 to 1, and in bull markets, this ratio can compress towards 15 to 1. If this ratio reverts to the mean, given the current gold price, the fair value of silver should lie between $150 to $200 per ounce. Second, regarding inflation-adjusted price, the 1980 silver peak was $49. Adjusted for CPI inflation, that price is equivalent to approximately $170 in today's purchasing power. Thus, at current levels, silver remains significantly undervalued compared to its peak purchasing power in the past. 2026 to 2027 outlook. Based on the supply-demand model and macroeconomic factors, rate cuts, weakening USD, geopolitical tension, I forecast that the silver bull trend is sustainable and structural. We cannot rule out significant volatility due to spasms in the derivatives market. However, the risk is heavily skewed to the upside. When inventories breach critical technical thresholds, for example below 50 million ounces at COMEX, market sentiment will shift from speculation to panic buying to secure production supply. The current texture of the silver market is not merely a standard commodity price fluctuation. We are witnessing the convergence of a perfect storm. The greatest investment opportunities often arise when the market realizes the dislocation between price and value, and with silver, that gap is wider now than ever before. Thank you for your attention.
Reuters has just released its latest macroeconomic report titled "Gold Prices Slip Lower as U.S. Inflation Figures Firmer, Dollar Rises." On the surface, the market appears to be reacting strictly according to the textbook. When the US dollar index, DXY, strengthens, algorithmic trading models automatically trigger sell orders for precious metals. The investing crowd is currently focusing their attention on gold, assuming the upward trend has stalled due to the hawkish macro environment. However, if we look deeper into capital flow data and the underlying market structure, a massive anomaly is currently unfolding in silver, one that retail investors are largely missing. While short-term price charts indicate selling pressure driven by high-frequency trading algorithms, the actions of smart money in institutional accumulators are telling a completely different story. This is not a sell-off to exit positions. Quantitative data suggests this is a classic liquidity shakeout. We are witnessing a sharp divergence between the paper price, futures contracts, and the physical price, real metal. While the paper price dips, physical premiums are rising. This mechanism is designed to flush out weak hands and leveraged speculators, allowing institutional players to acquire positions at a discount before the market establishes a new price floor based on actual, undeniable physical supply scarcity.
Let's dive into a forensic analysis of the market data to understand the gravity of the situation. In October 2025, China made an unprecedented move, exporting 660 tons of silver in a single month. To put this in perspective, this volume exceeds their typical annual export quota and runs completely counter to the strict strategic resource controls Beijing implemented earlier this year to protect supply for its domestic solar manufacturing base. According to basic economic laws of supply and demand, when such a massive supply shock hits the global market, asset prices should drop sharply due to the sudden surplus. But what is the reality? Silver prices not only didn't crash, but they also continued to break historical highs, surpassing $66 per ounce this December. Why this paradox? The answer lies in the rapid depletion of the Shanghai Futures Exchange's stockpiles. Data shows that silver inventory in Shanghai has collapsed. From a peak of 3,911 tons in January 2021, only about 780 tons remain today. Effectively, they have burned through nearly 80% of their strategic reserves in less than 5 years. The export of those 660 tons was not a commercial sale of surplus inventory. It was an emergency liquidity injection for the London Bullion Association. The London market is currently facing severe backwardation, a condition where current prices are higher than future prices, signaling a physical squeeze. China was forced to act as the supplier of last resort to arbitrage the price difference and prevent a breakdown of the global pricing mechanism. So where did that massive amount of silver go? It didn't stay in London vaults. Import data reveals a massive shift of physical capital towards India. In just September and October alone, India imported a staggering 2,600 tons of silver. The metal flows are moving from Chinese reserves through London and Hong Kong intermediaries and are being completely absorbed by India. This is not just jewelry demand. It is a strategic accumulation by Indian industrial conglomerates preparing for their own green energy transition.
This leads us to the bigger picture regarding fundamentals, which are currently stronger than at any point in the last 50 years. The year 2025 marks a collision between two opposing forces, inelastic demand versus finite supply. On the demand side, we are seeing inelastic industrial demand. The global transition to net zero relies heavily on silver. Solar. The latest TOPCON and HJT solar cell technologies require 20 to 50% more silver per panel than previous generations. This is a classic example of Jevons paradox. As solar technology becomes more efficient and cheaper, total adoption skyrockets, driving aggregate silver consumption higher, not lower. AI and tech. As we build out massive AI data centers, the need for high-performance connectors and switches is exploding. Silver has the highest electrical conductivity of any element. It has no substitute in these high-efficiency applications. Manufacturers are forced to buy silver, regardless of the price, whether it is $30 or $100, to keep multi-billion-dollar production lines running. Crucially, we must also consider the geopolitical risk premium. Silver is transitioning from a monetary asset to a strategic national security asset. Major producing nations like Mexico and Peru are increasingly discussing resource nationalism policies. If these governments decide to increase royalties or nationalize mines to capture more revenue, the global supply chain faces an immediate shock. We are moving away from a globalized free trade market for minerals to a fragmented protectionist environment. On the supply side, the situation is critical. We are facing a structural deficit. Mining output is flat or declining due to years of CapEx starvation and falling ore grades. Furthermore, 70% of silver is mined as a byproduct of zinc, lead, and copper. Even if silver prices double, copper mines will not ramp up production just to get a little more silver. This supply inelasticity means the market simply cannot respond quickly to the demand shock.
So, what is the scenario for the near future? At the current burn rate, the visible inventory in Shanghai is sufficient for only about 2 more weeks of trading. When this buffer disappears, the market enters uncharted territory. We anticipate a decoupling event. This occurs when the paper market, futures, derivatives, and the physical market break their correlation. Currently, the paper market operates on massive leverage known as rehypothecation. It is estimated that for every ounce of physical silver in the vaults, there are potentially hundreds of paper ounces traded. As long as investors are happy settling in cash, the game continues. But when industrial buyers, who need the metal for production, start demanding physical delivery that the COMEX or LBMA vaults cannot meet, the system breaks. Exchanges may declare force majeure and force cash settlements. This is the ultimate short squeeze. Short sellers will be forced to cover their positions at any price, pushing the price chart vertically to find a new equilibrium where demand is finally destroyed, a price likely much higher than today's levels. My strategic advice for investors is as follows. Do not let short-term volatility based on CPI prints or Fed speeches distract you from the geological reality. We are looking at a mathematical certainty of depletion at current prices. Institutional allocation to silver is currently less than 0.5% of global assets. If that allocation merely shifts to 1%, the buying pressure would be overwhelming. Silver is currently in the most attractive valuation zone relative to its growth potential. The gold-silver ratio is currently hovering near historical extremes. If this ratio reverts to its historical mean of roughly 60-1, or the geological ratio of 15-1, the upside potential for silver presents a highly asymmetrical risk-reward profile. This is a phase of wealth transfer. It is a transfer from those holding depreciating currency and unbacked paper contracts to those holding essential, finite, real assets. Ensure you are on the right side of this transfer.